How much equity should you give investors? In today's video, we will go over how much equity you should consider giving. You've built your company. An investor offers you capital. Now comes the difficult question. How much of your company should you give away? Too little, and the investor walks away. Too much, and you lose long-term control. In this video, I'll explain how equity really works, how dilution compounds over time, and how to make rational decisions instead of emotional ones. First principle: equity is the price of capital. When you raise money, you are selling ownership. The amount of equity you give depends on 1. How much money you are raising. 2. Your valuation. The formula is simple: equity given, investment, post-money valuation. Let's break that down clearly. Pre-money versus post-money. Simple explanation. Pre-money valuation. Value of the company before investment. Post-money valuation. Pre-money plus investment. Example: your company is valued at $4 million pre-money. An investor invests $1 million. Post-money valuation, $5 million. Investor ownership, $1 million divided by $5 million, 20%. You now own 80%. Simple. So how much equity is normal? There is no universal number, but globally, typical ranges are pre-seed, 10 to 25%, seed, 15 to 25%, Series A, 15 to 25%. Later rounds, 10-20%. These are not rules. They are common market patterns. If you are giving away 40-50% in an early round, that is usually a warning sign. The real risk: compounding dilution. Founders often focus only on the current round, but dilution compounds. Example: you start with 100%. Round 1, you sell 20%. You now own 80%. Round 2, you sell 20% again, but this 20% comes from the new total. After 2 rounds, you don't own 60%. You own 64%, because 80% x 80% are 64%. Add a third round at 20%, and you're down to 51%. 3 funding rounds, and you're close to losing majority control. This is why early over-dilution is dangerous. Raising more versus giving more. Sometimes founders try to minimize dilution by raising less money. That can backfire. If you raise too little, you may need another round quickly. You may negotiate from weakness. You may accept worse terms later. Sometimes giving 20% for sufficient runway is smarter than giving 10% for too little capital. The goal is not to minimize dilution at all costs. The goal is to optimize long-term ownership after growth. The valuation lever. The easiest way to reduce dilution is not to negotiate harder. It is to increase valuation. Example: raise $1 million at $4 million pre-money, 20% dilution. Raise $1 million at $8 million pre-money, 11% dilution. Same money, different valuation, massive difference in ownership. This is why strengthening valuation drivers before fundraising is critical. What about employee share allocations? This is where many founders get surprised. Most startups create an employee option pool, typically 10-15% of total equity. This pool is used to attract key hires: CTO, senior engineers, executives, early employees. Important detail: investors often require the option pool to be created before their investment, which means founders are diluted first. Example: you own 100%. You create a 10% option pool before investment. You now own 90%. Then you raise 20%. Now your 90% is diluted again. After the round, you may own around 72%. Many founders underestimate this effect. Employee equity is necessary, but it must be planned strategically. Narisar: control versus ownership. Ownership percentage is not the same as control. You can own less than 50% and still retain control if you have majority voting rights. Shares are structured differently. Investors are minority holders. Board structure is favorable. However, losing too much equity early reduces strategic flexibility later. Balance is key. Should you ever give 50%? In early-stage venture funding, giving away 50% in the first round is rarely advisable. It reduces motivation. It weakens negotiating position in future rounds. It signals weakness to later investors. There are exceptions, but they are uncommon. Labras: practical example. Let's compare 2 founders. Founder A raises small rounds, gives away 15% 3 times, creates 10% option pool. After 3 rounds, may still own around 50-55%. Founder B raises aggressively early, gives away 35% in first round. Adds option pool, raises again at 25%. Founder B could be below 40% ownership quickly. Both may build successful companies, but long-term wealth outcomes will differ significantly. Narisar. So, what should you aim for? There is no magic percentage, but reasonable principles are: avoid giving more than 25% in a single early round unless necessary. Plan employee option pool early. Model future dilution before agreeing to terms. Raise enough capital to create meaningful progress. Focus on increasing valuation, not just reducing percentage. Equity is a long-term asset. Every percentage point matters. Final thoughts. When raising capital, think beyond the current round. Think about future rounds, option pools, control, exit scenarios. Equity decisions today determine wealth distribution years from now. If you want to understand how valuation impacts dilution, you can use the free business valuation calculator at www.valuation4u.com to model different scenarios. And if this video was helpful, subscribe for more clear guidance on business valuation, equity, and fundraising strategy.